This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks slide. Markets finish the week with losses as a further decline in oil prices spark concerns of a global economic slowdown. Picking up steam, a key gauge of inflation rose at its fastest pace in about 6 years, and it did not go unnoticed by investors or the Fed. Up for auction, the priciest listing in the country will soon be owned by the highest bidder. Those stories and more tonight on Nightly Business Report for this Friday, November the 9th. And we do bid you good evening, everybody. Welcome. Sue is off tonight. A fresh round of selling hit Wall Street today. Stock prices were once again led lower by technology shares and by energy stocks after oil fell for a 10th straight session, its longest losing streak in 34 years. Here are the closing numbers today. The Dow was down 201 points, back below 26,000. The Nasdaq fell by 123. The S&P declined by 25. But after this very busy week with the midterm elections, a Fed meeting, and more earnings reports, the major averages were all higher, thanks in part to that big monster rally on Wednesday. Not so for oil, though. Today, domestic crude settled just above $60 a barrel, a stunning reversal from just a month ago when it hit that four-year high around $76. Now, even though oil prices have been falling, overall producer prices have been rising a lot. The closely watched inflation gauge rose at its fastest pace since 2012 last month, adding to concerns about the path of interest rate increases by the Federal Reserve. Steve Leisman has details for us tonight.
A hotter than expected report on wholesale prices has economists wondering, does the U.S. have a brewing inflation problem? With higher wage costs, tariffs, and faster economic growth, economists think it's a concern at least worth taking seriously. The government reported a 0.6% rise in the October Producer Price Index compared to last month. That is twice what was expected by economists. The PPI was fueled by gains in transportation and warehousing costs and wholesale goods and foods. Economist Stephen Stanley with Amherst Pierpont wrote, quote, food commodity prices finally turned higher after several months of significant declines as farmers were struggling in the wake of retaliatory tariffs on their products by China. When companies face higher prices, they have three choices: reduce their profits, pass along the cost to consumers, or try to increase efficiencies.
Businesses have not been able to pass their higher cost on to consumers. And you see that in some of the recent announcements where you see that chains are consolidating operations in some ways to get a handle on labor costs and to get more efficient operations. So they're trying to squeeze a little bit more efficiency out of their operations because they can't pass through their higher cost.
The PPI is up 2.9% year over year, but with several quirks in the data, economists like Vittner are reluctant to embrace the outsized gains as a full-fledged inflation threat, especially with oil prices falling. Instead, they'll be looking to next week's consumer price report.
It looks like the Fed is pretty locked into December. Obviously, the PPI running hot, as you said, will help lock them in. The CPI next week, probably is going to be a touch on the hot side.
So to the question of whether there really is an inflation problem, it's probably too soon to tell, but definitely worth keeping your eye on the price. For Nightly Business Report, I'm Steve Leisman.
So how concerned should consumers and investors be about inflation and its impact on our Fed policy and the markets? Joining us tonight, Jason Ware, he's Chief Investment Officer and Chief Economist at Albion Financial Group. Jason, good to see you. Thanks for joining us tonight.
Yeah, good to be with you.
You're not that concerned yet about inflation, are you?
We're not. If we look at the broad preponderance of inflation data, the evidence is suggesting that we're still running pretty close to what the Fed would consider to be target inflation. That's in and around 2%, particularly if you look at it on a core basis, whether that's PPI, as you guys were mentioning, or whether that's consumer prices, CPI, preferred measure for the Fed, PCE. Things are still looking like they're in check, so we're not terribly concerned for now.
Is there a number that will concern you? I mean, is there a level that we get to when you'll say, okay, now we're starting to have a problem?
Yeah, there is. I think as we see inflation creep up closer to 3%, both the stock market and the Fed will take, I think, a more direct notice at inflation running at those levels. And again, headline can be noisy, so it's important to pay attention to core inflation numbers. And I think as we get close to 3%, if we were to get close to 3%, that would be something that would have us more concerned. And in particular, watching wages and labor costs as a indication of that.
Now, we often just characterize inflation as a bad thing, something to be avoided, but there are sometimes winners in inflationary periods, and you sent us a list of some. I want to run through those quickly and maybe get you to comment on a couple of them here. You talk about companies with pricing power or firms that produce and sell, for example, chemicals, oil companies. Then there are raw materials producers, real estate firms, real estate investment trusts, and inflation index bonds. Are any of those looking to be attractive to you yet? Are these things that you would want to think about investing in as you anticipate inflation?
Not so much. And here's why. One, because again, we're not terribly concerned about inflation running hot. Two, because investors should have a diversified portfolio that captures the upside if we do get inflation in more of a natural way, more of a natural posture. So instead of trying to predict whether inflation is going to go up over the short run, which really, as much as we try to do that with evidence, nobody can do, repeatedly over time. I think it's important that investors have a portfolio that has some exposure to areas that will do well when inflation goes up, but also has exposure to areas that will do better when inflation is in check like it is today. So I wouldn't be loading up on any sectors in that list, although that's typically the who's who of suspects that will do well in inflation. Every environment, every cycle is different, so the variables to return are difficult to calculate and don't always show up in the same way each time. So just having a diversified portfolio to capture the returns in the market is probably the best way for investors to position themselves.
Very good. Jason Ware with Albion Financial. Good to see you again. Thanks for joining us.
Yeah, good to see you. Thank you.
Elsewhere, Disney was the best performing Dow component today. Shares rose more than 1.5% after reporting those strong quarterly results last night that we told you about. And while the company's studio business powered its bottom line in the most recent quarter, the company's making a high-stakes push into digital as it looks for future growth. Julia Borston has more on Disney's strategy.
Disney CEO Bob Iger announcing that Disney Plus is the name of the streaming app launching next year, featuring Disney's major brands, plus Fox's National Geographic.
We're weaning ourselves of third-party licensing, which we've already started, so that the product appears on our service and not on third-party services.
As for Disney's first direct-to-consumer app, ESPN Plus, Iger says it's doing extremely well.
He understands that the fundamental thing about a digital economy is that you can go direct to consumer. And he's not burdened by having a cable network, a cable, operator, but he has ESPN, and he's shifting that away so that it can go direct to consumer.
Iger says the company's also planning to invest in Hulu and hoping to grow it internationally. Iger telling me that after Disney's acquisition of Fox closes, he would be interested in buying the remaining 40% of Hulu from NBC Universal and AT&T's Warner Media.
Our plan is to invest in all three services, the ESPN service, the Disney service, and the Hulu service, so that we achieve our goals in terms of not just going into the direct-to-consumer space, but transforming the company by being in that space.
With so many streaming options, including Netflix and Amazon, investing heavily in content, the question is how many of these services customers will be willing to pay for.
The competitors, especially Netflix, are kind of entrenched here. So, you'll get additional signups for Disney, but it's sort of still will be like a thing where you subscribe to many services, I think.
Iger saying he sees a huge family audience to target with Disney Plus, and now they're working to have enough volume of quality content to attract subscribers. For Nightly Business Report, I'm Julia Borston in San Francisco.
Big changes are coming to another Dow component. That would be Procter Gamble. A new CEO is shaking things up at that company. He says he's willing to change anything and everything to increase results and create value for shareholders. Investors apparently like that idea. They sent the stock higher on this otherwise down day. Sarah Eisen is in Cincinnati, where P&G is headquartered.
Procter & Gamble announcing what it is calling the biggest organizational shakeup in more than 20 years. It's dividing up the company into 6 different business units, like grooming and beauty, that cover the biggest markets like the US and China. It's a shift in the way P&G does business to make things more simple less complex, and lead to faster decision making and better innovations. CEO David Taylor says it's the latest step in a multi-year turnaround.
Without a question, the goal for all that we're doing, both our superiority strategy and the organizational change, is to get to balanced growth and value creation. We believe strongly the path we're on, which is leveraging superiority of the product, the package, our go-to-market capability, our communications, and consumer and customer value. Doing that right will cause us to win. A big part of winning go-to-market is making sure we're agile to serve the customers or distributors in each market.
And the turnaround is bearing fruit. P&G just posted its best quarterly sales growth in 5 years, despite the fact that macroeconomic conditions are tough. That hurts P&G in the form of a stronger U.S. dollar, higher commodity costs, and yes, the trade war.
What I worry most about with the trade war is if it destroys consumers' confidence in American brands, and I have not seen that. As long as you're producing in China, and most of our brands we do, then the tariffs don't have a huge impact. Do I think I would love to see that this be resolved. I think it'd be good for the global economy, good for our country, good for China, for a productive and constructive resolution of this. It's not good. I believe, and our company believes, in free and open trade. We think that raises all boats.
And while Taylor is worried about the impact of the trade war, and particularly confidence in brands, he says the dollar hurts more and that the global economy looks to be in good shape. All 10 categories, he says, are growing not just in the U.S., but globally, and even in China, where there are widespread reports of a slowdown. For Nightly Business Report, I'm Sarah Eisen in Cincinnati.
Turning now to California and that raging wildfire, two of them actually across the state. In the southern part, there's concern that the Santa Ana winds will fuel the firestorm even further. Evacuations have been mounting in Ventura and Los Angeles counties. In the north, a deadly fire there nearly quadrupled in size just overnight, wiping out the entire town of Paradise, and it caused tens of thousands of homes and businesses to lose power. In fact, shares of PG&E, which is the state's largest utility, fell by 16% today, its biggest one-day decline since at least 2002. And Edison International, the parent of Southern California Edison, fell by 12% in today's trade. Time to take a look at some of today's upgrades and downgrades. We start with GE's shares. Their price target was cut to $6 from $10 at J.P. Morgan. The analyst cited GE's recent quarterly results, which he said were worse than he expected. The firm is maintaining its underweight rating. Shares fell by 5% to $8.58, its lowest close since the financial crisis of a decade ago. Monster Beverage was added to the conviction buy list at Goldman Sachs. The analyst says the concerns over a competing drink from Coke are overblown. Price target, $66. The stock rose by 5% to $56.84. Yelp was downgraded by a number of firms today, including Raymond James, which cut its rating to market perform from outperform. The analyst says that the bull case for this stock has come to an end following its disappointing quarterly results, which we showed you last night. The firm also pointed to Yelp's productivity problems. The stock tanked by 26% today to $31.93. Still ahead with a decline in oil prices, you might not have the stomach to buy stocks in that sector, but our market monitor this week says there are some names worth owning. A judge in Montana has blocked construction of the controversial Keystone Oil Pipeline. The ruling said that the Trump administration, which approved this construction, did not take into account the effect that the project would have on climate change. The pipeline is designed to carry heavy crude oil from Canada into the United States. TransCanada, the company behind the project, though, says it does remain committed to building the pipeline, but investors were skeptical. They sent shares down in today's trading. Everyone is waiting for official word from Amazon on where its second headquarters is going to land. Reports earlier this week said that it could be split into two locations, one in Long Island City, New York, the other in Crystal City, Virginia. In the meantime, investors are keeping an eye on a group of stocks that could be impacted the most if HQ2 is split in two. Diane Olick has more for us.
The signs look pretty good for Long Island City, New York and Crystal City, Virginia. Amazon has not confirmed its choice or choices for HQ2, but investors are already honing in on the stocks that could benefit. So apartment REITs are in play. For Long Island City, Avalon Bay is the clear winner. They have direct exposure there. The stock jumped higher Monday after reports last weekend that Crystal City was in the lead and then that Long Island City could share the project. Avalon has been in Long Island City for over a decade with several high-rises. For Manhattan overall, which is just across the bridge, other beneficiaries are UDR and Equity Residential. They all have about 10% of their portfolio exposure in Manhattan and Brooklyn.
Picking Long Island City is huge for Manhattan. I mean, let's face it. There's been a tremendous amount of supply that's been built in Manhattan along with the boroughs, and rent growth has not been great this cycle, in part because of the glut of high-end apartments.
And the same is true in the D.C. area around Crystal City. REITs that could benefit there, also Avalon Bay and Camden Property Trust. Although it's based in Houston, its overall D.C. exposure is close to 20%, and Northern Virginia is 6% alone.
Instead of getting, for example, rent growth of, let's say for the sake of argument, 1% or 0.5%, the rent growth could be in the 2 to 3% range for those REITs owning assets in that market. So that would be pretty significant.
But most important for apartment REITs here in Crystal City and in Long Island City is how many of the new Amazon employees will come from within the market it picks and how many will move in and take up new space. For Nightly Business Report, I'm Diana Olick in Crystal City.
Revlon shares are photo ready, and that's where we begin tonight's market focus. The beauty products maker reported a narrower loss than expected and outlined a restructuring plan. The goal is to improve productivity, profitability, and cash flow. Shares soared by 31% today to $28.61. Tribune Media's profit got a lift from higher ad spending, especially political spending. The company topped earnings estimates and saw revenue rise double digits from a year ago, and that stock rose a fraction today to $39.25. EW Scripps reported better than expected earnings and revenue in the most recent quarter, with the media company helped in part by the networks that it purchased last year. Scripps expects revenue from local media to rise by at least 30% in the current quarter. But investors apparently wanted more. That stock fell 5% to $16.85. And sandwich chain Potbelly reported earnings and sales that missed expectations. That company also issued disappointing earnings guidance for the full year. The CEO said that Potbelly will continue to make investments, though, to try and increase brand awareness. The stock was down 6% today to $10.86. This week's Market Monitor has 3 energy picks that he says all offer something different. There's value, there's growth, and a bargain. It's his first time joining us as Market Monitor. He is Rob Thummel. He's Managing Director and Portfolio Manager at Tortoise. Rob, good to see you again. Welcome back.
Thank you.
The 3 we're going to get to in just a moment, they don't have anything really to do with oil. So you're playing it differently in the energy sector, aren't you?
Yeah, Bill, we do see opportunities here at Tortoise of investing in the energy sector that aren't associated with oil prices, believe it or not.
So you go with Cheniere Energy, for example, with liquefied natural gas. Why do you like that one?
Yeah, so Bill, at Tortoise, here's how we look at the U.S. energy sector. We see over the next decade, we see increasing production of U.S. produced oil, natural gas, and natural gas liquids every single year, year after year. We also see growing consumption of those same commodities. But this is the game changer, Bill. We see growing exports of liquefied natural gas and crude oil going forward. And that's where Cheniere comes into play. So Cheniere is the purest way to play the growing demand for liquefied natural gas exports. Global liquefied natural gas demand is going to increase, actually double over the next couple decades. The U.S. is actually going to be the second or third largest supplier of liquefied natural gas to the rest of the world. Cheniere is the only way to play that right now, and we think it's an excellent way for investors to get exposure.
And if you expect an increase in production, you got to move it from place to place. So you're going with one of the pipeline companies, Enterprise Products Partners, right?
Yeah, yes, exactly. So what we like about Enterprise, it's a diversified company that operates really essential energy infrastructure assets across the entire U.S., basically. So, if production is going to grow, as you mentioned, year after year, you need to move that oil and gas. You need to transport it. That's what Enterprise does. They have a stable business model that allows them to pay investors a 6.4% effectively dividend yield. We've owned the stock for over a decade. Enterprise has grown that dividend every single quarter we've owned the stock. So as the U.S. energy infrastructure network continues to expand, Enterprise will really play a critical role and is a stock that investors want to hold as well.
Finally, and quickly if we can, this is your bargain. This is a company that's involved in natural gas, EQT Corporation, but the stock is down 44% this year. I guess you're expecting them to come back. Are you expecting natural gas prices to come back?
So it starts with natural gas prices, and if you notice, natural gas prices have been on fire this week. They have gone up significantly. You know, we've entered the winter heating season with natural gas inventories at the lowest level they've been since 2005. So the background for inventories are pretty good for prices. But EQT is more than just about prices. They're the largest natural gas producer in the U.S., number one. Number two, they own some of the best assets in the coveted Marcellus Shale region. Now, they've had some operational hiccups. That's why the stock's down. The management has made some changes. We think that due to the management changes, the backdrop for rising natural gas prices, that this stock's really set up for a pretty good turnaround story for whether it's 2018 or into 2019.
Very good. Rob Thummel with Tortoise. Good to see you. Thanks again for joining us tonight.
Thank you.
And to read more about Rob's picks, you can head to our website at nbr.com. Coming up, calling all bidders.
I'm Robert Frank. There is a flood of mansions on the market, and that's leading more and more of them to head to auction. We'll take you inside the most expensive home ever to sell at auction. Coming up on Nightly Business Report.
Here's what we're watching for next week. On Monday, lawmakers return to Washington with a full agenda, which includes funding the government and that potential fight over the border wall. On Tuesday, OPEC's monthly report will be in focus, given the decline in oil prices. On Wednesday, Dow component Cisco reports earnings, and investors are expecting to see growth. That's what we're watching in part coming up next week. The FDA reportedly plans to sharply restrict sales of flavored e-cigarettes by pulling them from convenience stores and gas stations. The agency's action could come as soon as next week, and it's aimed to limit access to e-cigarettes among children and teens. Preliminary federal data do show that use among high schoolers has risen by 70% since last year. Christie's plans to auction a pink diamond that could fetch $50 million. The 19-carat rectangular cut gemstone is the largest vivid pink diamond that the auction house has ever sold. It once belonged to the Oppenheimer diamond family, and Christie says it will be the standout offering at the fall jewelry auction in Geneva on Tuesday. So what goes best with an auction for a pink diamond? Well, how about an auction for a multi-million-dollar mansion? Robert Frank went to Hillsborough, Florida to give us a tour.
4 years ago, this was the most expensive home for sale in the United States, listed at $139 million. Next week, it heads to auction for no reserve, marking a dramatic turn for one of the most opulent estates in the country. And it's a story that's becoming increasingly common in the struggling market for high-end real estate. Simply put, America has a mansion glut. There are too many giant homes with too many big prices up for sale. After the financial crisis, builders went big, targeting the rich with ever larger and more expensive homes. But now overseas buyers are fading, stock markets are more volatile, and prices ran up way too fast. So buyers are sitting on the sidelines. The most expensive homes in the top 40 markets in the U.S. took nearly a year and a half to sell in 2017. So sellers are now turning to auctions, usually associated with distressed real estate. Real estate auction companies say business is up 20 to 50% this year, driven mainly by high-end homes.
When sellers call us, number one, they're motivated. They want the property to sell, and that's why they're calling an auction company to help to create that sale within an accelerated time frame. But number two, they also want the best price, right? These are smart people. They own valuable properties because they earned the ability to own them, and they don't want to give them away.
But the price drops can be dramatic. This house in Dallas had been listed for just under $50 million and sold for $36 million at auction. A home outside of Los Angeles, which became famous for its massive underground complex of spas, pools, and tennis court, was listed for $53 million and just sold at auction for $23 million. Famed investor Peter Lynch is putting his golf home in Scottsdale, Arizona up for auction next month after it languished on the market for 2 years at $14 million. Now, auctions don't always work. Michael Jordan tried to auction off his Chicago mansion in 2012 with no takers. But the owners of this house, called Playa Vista Isle, have high hopes that it will become the most expensive home ever to sell at auction. No one has ever lived here. It was built on spec in 2014 and came on the market for $139 million, then put back on at $159 million before being pulled off the market in 2016. It is 58,000 square feet with 11 bedrooms, 22 bathrooms, a private IMAX theater, 20-car garage, 500 feet of ocean frontage with a private yacht dock on the Intercoastal. It takes about 150,000 gallons of water just for the pool. Now, bidding starts online on November 12th, but you need a check of $250,000 just to qualify to bid. For Nightly Business Report, I'm Robert Frank.
Before we go, quick look at the day on Wall Street. Down day, the Dow back below 26,000. That's NBR for Friday. Thanks for joining us. I'm Bill Griffith. Sue's back on Monday. Hope you are too. Have a good weekend.